Good afternoon, ladies and gentlemen, Mr. Chairman. Good afternoon. Thank you very much for patiently waiting for us for this important discussion. Allow me to say that we, the Greeks, have invented a lot of things and introduced to this world, such as philosophy, democracy, mathematics, medicine, but unfortunately we did not invent and did not found the marine insurance. That was founded in London in the 17th century in the coffee house. So, interesting discussion on marine insurance and reinsurance, where it is heading. Allow me to introduce the panelists. On my left-hand side, Mr. Ilias Tsakiris, CEO and manager of the American Hellenic Hull Insurance Company Limited. In the middle, Mr. Costas Joannides, CEO of Marsh, Cyprus. And on the far end, Mr. Stephen Cooper, CEO of Fourth Insurance Office. Gentlemen, I will ask my first question in line with our scope today. I would like to raise the question as a moderator: where is your line of insurance business heading? Mr. Steve.
Thank you. Thank you, and I will restrict my comments to the management liability lines, and on behalf of the Americans who invented the class action suit and the securities derivative action, I will tell you that we are seeing an increase in frequency of claims in those areas, but just moderate growth in the severity, which would suggest perhaps moderating and level rates. For those of you who attended last year's conference, I was privileged to be invited to a similar panel. And I was asked to comment on the management liability lines, and I made a forecast at that time that rates would be firm, perhaps with an upward tilt to them. Following my statement, I received a question from the audience, and the question was, yes, rates are going up, could you tell us when? And I predicted that Thursday at 4:30. And since I am back again for the second year, my prediction was incorrect. It did not happen that Thursday at 4:30. But I said that for a clue to where insurance rates should be going, we should look to the capital markets. And with the recent fourth quarter and first quarter of this year increase in intermediate term and short-term rates, I think we will see a reduction in the capital flows into the capital markets, from the capital markets, which have allowed a very generous expansion and capacity in the management liability lines. So with interest rates going up, contrary to tradition where higher rates meant lower insurance rates, I think now with higher rates causing capital flows to diminish, we have started to see an increase in reinsurance rates for the management liability, the directors and officers insurance lines. I will, however, tell you that on marine cyber insurance, due to the influx of new carriers writing this insurance, and due to the fact that the marketers looking for increased market share in this emerging line, having the will to overcome the desire of the actuaries to raise rates, we will continue to see softness and ample capacity in the marine cyber line. So on management liability, we see rates and renewals going up for this year. On the cyber lines, kind of steady to lower. A recommendation for the owners and those involved in procurement is to seek out opportunities for perhaps renewals this year for a period of longer than a year. We think there will be a value to arranging for stability in this market before increases become more market.
Thank you, Steve. What's that?
I think I will allow Ilias to lead on this one because we are bound to disagree.
Well, I think that there is no clear direction of where exactly, especially in hull machinery, the markets and the underwriters will be heading. I think that the low circle of premiums I think has ended, but still there is plenty of capacity in the market. A lot of underwriters tend to have different strategies, and depending on in which part of their life circle we find them, these strategies will be defined. For example, the younger underwriters, the newer underwriters, will tend to increase their market share, so they are willing to make certain concessions as far as their pricing is concerned. However, the more established underwriters will tend to stop the slide of the rates.
Thank you. Thank you, Ilias. Costa, I will ask you the next question, which is a follow-up question to my first one. It is apparent that the P&I market is currently in soft condition, with nil general increases, mutual cashback, and reductions available. In contrast, the hull market has been showing signs of hardening. What are the driving forces behind this? I believe the ship owners would like to know and given an explanation and understanding of this unorthodox and paradox situation we are facing nowadays. Please.
From our point of view on the insurance broking side, there's a clear sign of P&I clubs having excess reserves. And these excess reserves have been built up over a period of time. And you know, as a mutual organization, going in tandem with the shipowning membership, they have decided to rebate back some funds, whilst they are trying to keep the rating base where it is today. On the hull and machinery side, yes, there have been some signs of stabilization, I would say. I will disagree with the hardening of the market. This is not the results that we have been able to show to clients, and this is a common consensus, I would guess, from the insurance broking world. There is this overreaction from the London market, which is known and customary when things are being pressed at literally very competitive rating base. The London market leads the way to try hard and increase the insurance cost. Then the Scandinavian market is trying a little bit less, harder to align. But in general, since there is overcapacity around the world, in general, I would say the market has not changed yet. So I would agree with Steven that probably we will be sitting here next year saying that there will be a hardening market, but since the core market is still at so low rates, and I'm talking about the shipping market, the underwriters will not have, unfortunately, the luxury or the stamina to press the rates up. Obviously, they are fundamentally more careful and more thorough in their evaluation, and they look at the long-term cooperation that they may have with existing clients. They look at and vet the management quality levels, and certainly performance-related indicators that would give them at least some ammunition to impose some sort of increase.
Thank you, Costa, but allow me to respectfully again disagree and use the word hardening. We pay them premiums and we feel that. So it is hardening the hull market, and you know, we expect better work from everybody in the broking side. So, Ilias, any comments on that?
I would agree with all of you.
The thing is that the hull market, especially the hull market, has been recording losses for the last 20 years. So I think that the underwriter will try to find an excuse for stopping this slide. However, I would say that the golden rule for this particular year would be that at least as expiry premiums on good records and some medium increases on bad claim records.
Thank you. Stephen, would you like to add something on this?
Yes, I would, and I think that we should not ignore certain catastrophic natural losses that have occurred outside of our industry, which could certainly have an impact. While we all endeavor to have good safety records and remain compliant and paint a picture for the underwriters that is as favorable as possible. Again, we're talking about the availability of capital and the rates of return in the credit markets, but let us not forget the fact that certain natural disasters, which will cause losses for reinsurers, will have an impact within our industry, even though they are unrelated.
Thank you very much. My next question is, there is apparent pressure on deductibles across marine classes of business. Should owners be thinking of raising their retention by increasing deductibles or protect these at all costs? Is there sufficient incentive to be given from the underwriters to promote these?
This is an oxymoron in a sense because the market is fairly low. So I don't think that if I was on the other side, I would recommend that. I would love to see as an underwriter that deductibles going up, but there is no real benefit for the owners to take such a risk when the premiums are so low. This is a discussion, this was back 20 years ago when the captives were started appearing, when the deductibles were increasing in order to save, let's say, as far as the level of expenditure of the premiums. But I don't think at this stage with the level of premiums that the owners would elect to increase their deductibles. There's not going to be any real financial benefit.
Costas?
From our perspective, as a guiding rule, I don't think that I have ever recommended any of our clients to accept higher deductibles because it's a particular aspect of the insurance contract that once you get the deductibles increased, it's very difficult to negotiate them back down to today's level. So for me, and in line with what Ilias have just said, I think the cost-benefit analysis in switching to higher deductibles against returning premium would be probably unworkable and economically not viable, unless, of course, we're not looking at attritional increases in deductibles. Very big corporations now consider deductibles of 1 million or even 10 million. And then within that bigger retention, there are other mechanisms that one can put in place to protect a catastrophic sequence of claims that would result in a multiple payment of that huge deductible. So only if a ship owner would want to see deductibles of the extent that I previously mentioned would probably be giving some positive signs. But again, I think it's also a matter of mentality. In the markets that I am involved, especially in Cyprus, in Greece, and in Germany, any discussions on deductible is literally out of the question.
Thank you, Costas. Stephen, would you like to add something?
Yes, I would urge owners not only to consider this an insurance question, that is the advisability of raising up deductibles, but more of a finance question, to take a look and see how that cash can best be deployed within your business. If the cost of capital is rather low, perhaps low deductibles with higher premiums would make sense. But if you have a better use for that cash, perhaps it does make sense if there is a reasonable translation between increases in retention and drops in premiums.
Thank you very much. My next question is a subject which is a very hot topic nowadays, and this afternoon and this morning has been touched either directly or indirectly. It's the cyber risk. Cyber risks are on the increase across all trades. However, the Marsh attack brings this into a sharp focus in the marine context. Would ship owners be better advised to invest in preventative measures, such as consultations, equipment, other security equipments, or in an insurance solution, on which there seems to be limited options at the moment? Stephen, please. You touch on your first.
Thank you.
Yeah.
Thank you. I don't think the expenditure of funds on advice and advisors to prevent a cyber incident is mutually exclusive to purchasing insurance. In many cases, in some of the broad form marine cyber policies, not only do you receive financial protections, but you will also get the kind of advisory services that will help you on a diagnostic basis to take the steps necessary to reduce the probability of your experiencing a cyber event. Again, buying cyber insurance will not prevent an incident. Preparation will. So for those who are considering cyber insurance and decide to defer it, do not defer the decision and the prudence of sitting down with response advisors, crisis consultants, IT experts, and extortion consultants to find out and to put together a plan as to how you would respond to an event as if it would happen tomorrow. Again, you can postpone the insurance decision, but do not postpone the decision to identify those advisors, those first responders, who will help you mitigate the cost of a loss.
Thank you, Stephen. Costa, I believe that the current insurers should absorb this kind of risk and consider it as a reasonable extension to the extending coverage, at least on Harley machinery covers. Your thoughts on that?
This time I want to go ahead of Ilias. Well, I totally agree with you, because there is the tendency of creating new products for new risks. We can go as far back as coffers, the KNRs, where multi-million or billion new line of business was suddenly appearing on everybody's desks. And if I may say, the lack of the traditional insurers to extend coverage or produce themselves the necessary instruments to cover for these risks. Yes, I do agree. The current exclusion from the primarily hull and machinery insurance, war risks insurance, and loss of hire of cyber exclusion, for me, it has been there by coincidence, because it has not started from the marine spectrum, but from the banking world in the States, and it found its way through insurances, and then on the direct insurance, lumbering this exclusion on the ship owners. So my second port of call, the first being what has been discussed by Stephen and Loucas, which is the hands-on approach and try to identify. The second port of call would have to be your existing insurers to be convinced to exclude the exclusion and position yourselves on your existing contract. This has benefits. First of all, the coverage issue is sorted, and secondly, if there is an additional premium, then this premium is going to your current underwriters who are funding already claims on other aspects of the coverage, and therefore it will boost the premium pool that is already an expense to the ship owners.
Thank you, Costa. I appreciate that, Ilias.
There are, I hear, it's not the first time I hear that Hellenic should exclude the cyber exclusion clause. However, there are certain technical restrictions to this, which is basically how you price a risk which you don't actually know. And usually there has to be claims first, as it happened with piracy, for example, during the Aden in Somalia. There had to be a few ransoms to be paid first in order, let's say, to quantify and actually price the risk. Equally, I think the cyber risk has another issue, which is the credibility issue. Especially for listed companies, how can you make a claim, for example, that somebody hacked your system and took over the ship and, for example, ran her aground or black out the engine or something? So there would be credibility issues that no one would like publicly to, how can I say, communicate. Equally, for example, if there is a blackout now in an engine room, and this causes software failures, for example, it's not always malicious, cyber issues are also sometimes a computer glitch, as we say. We will class it as Hellenic as an engine failure, not as a computer failure. Equally, and the last thing I want to say is that how we gather the data in order to quantify the risk. There is no actual representation. Nobody actually tells us if there are computer glitches on board the ship, for example. And I will, the last thing I want to say that in the NHS, when the NHS in England was attacked, the glitch was that there were certain softwares that they were not updated, or they were there, but they were not updated. In the ships, for example, that they don't have internet access, there is the possibility that all this software is not updated. So they are more susceptible for further attacks. So I would say that before to cut this short, is that we need to have claims, we need to have losses in order to price this particular risk before we lift this exclusion.
Well, I'm just wondering whether, Ilias, you could give an answer, because here in the audience you have ship owners insured for hull machinery, and the straight question would be, if there is a cyber attack on board the ship and the ship runs aground or has a collision, would the claim be recovered?
Now, depending on the circumstances, for example, depending on the wording of the contract itself, if, for example, it involves the additional perils clause, which covers any accidental damage from any person. So, I'm talking about English clauses now. So this would be possibly covered. On the other hand, if there is a negligence on behalf of the crew operating a computer system again, this is a negligence which is covered. So I'm just saying that I understand the discussion about cyber, but in actual terms, that if somebody from the crew doesn't read properly what's on the screen, it's not a cyber risk, it's a negligence itself. So I would say that between us, that nobody listens, is that this is this is another product, let's say, I would suggest that requires attention. And we don't actually have any data to actually say that this is how we're going to do it. So I would say that negligence and grounding is a grounding, and I would say that yes, we can, especially on additional, with additional perils clause, I think it's accidental in nature, so it will be covered.
Thank you, gentlemen. There is no doubt that there is still a great area, the cyber risk, which is a lot of work to be done, and I'm sure that other opinions and suggestions, etc., they will be introduced in the future. Thank you for that. The last question is that with international insurance markets expanding into the marine sector, there appears to be a growing list of options for buyers, and indeed their brokers. What is the value of marine pedigree and quality security behind these markets? And is there a balance to be struck in selecting your policy participants? Stephen.
Well, new entrants coming into a market always suggests more price flexibility, increased capital, and advantage to buyers. But I think in the case of the marine industry, the relationship between insurers and owners is more than the case of someone going out and seeking a product that has been commoditized. There's an important service aspect, particularly when markets get hard. The relationship between an insurer of long standing and a ship owner is truly viewed as a partnership. And that partnership cannot be affected when a new entrant comes into the market and seeks your business at a minor discount or some other price advantage. So I would say that the decision to consider a new entrant into a market should be taken very, very carefully and seriously, and that in itself, a minor savings, should not be viewed as justifying the ending of a partnership and a relationship. Don't forget the service aspects that come with the relationship with your hull and machinery underwriter, your P&I club. So while I think we should welcome new entrants to the market, it adds to stability. I think that it is a minor complication in the decision-making process for owners.
Thank you, Stephen. Costas, would you like to add something on this?
I would agree with Stephen. Basically, in addressing the issue of security, big corporations on the insurance mediation side would have their security committee, set of analysts that will analyze the financials of any new entrant. They have rating bands of certain level. They will also be investigating the promptness in claim settlement and so on. So from our perspective, unless the underwriter has been vetted internally in all the applicable areas, we wouldn't be able to then propose to our clients to take up such security.
Thank you, Costa. We have only 3 minutes left, and thank you very much for this interesting discussion. I would like to say that I believe there is a stability in the insurance market at present, and that ship owners will be able to continue considering their options for more competitive rates and premiums, including deductibles. And I would like to see that the hull and machinery underwriters, they will extend the risk as far as the cyber is concerned, remain to be seen. Any questions from the floor? Polis, would you like to add something? Mr. Tsakiris would like to ask a question.
Not actually in the form of a question, it's a comment. What's happened so far, you've been talking about the idea of insurance premium ratings. I mean, obviously very modern ships get ridiculously low premiums. You get a $30, $40 million bulker insured for $70,000, $80,000 a year with a $50,000 deductible. Would you think that maybe, it hasn't happened of late, but you should place also more emphasis on the fact that, the two factors. Number one, that sometimes older ships should not be unduly penalized. There are certain conventional fleets, very traditional fleets, which have ships of say 10, 12, 15 years old, which sometimes are misperceived as being a second-rate risk and sometimes they can be penalized. The second aspect, which I find quite astonishing, is the insurance market, is that people have placed no emphasis on the terms of cover. As you know, you've got the basic cover, you've got the Institute Time Cruises hulls, you've got the old Institute Time Cruises, as amended, you've got the Norwegian form, you've got the old American hull form. Personally, I find that the widest cover of insurance, the widest cover, the contract cover, is the old American hull form, 1977. But you find a lot of fleets which have maybe 40 and 50 ships, and you ask what their policy terms are, and they kind of say, well, I've got Institute Time clauses. When you ask which one, some of the companies are not even aware of the fact that the modified clauses are more restricting than the older ones. And of course, last but not least, as I say, the best trump card for a good fleet to have the widest form of cover is the old American hull form. Thank you.
I would agree with Mr. Tsakiris on this. Costa.
And I will respectfully disagree with both of you. The widest terms available are based on either German terms or the Norwegian plan. And there are fundamentals which is not the forum to analyze. But there is one basic factor where you can call upon when you find me in the corridor, and it's effectively the burden of proof. Both of these policies are always policies. That doesn't mean they cover everything, but by the virtue of their sort of substance, the burden of proof lies on the underwriters, not the ship owner. So the ship owner can just point the finger to the damage, and then it is upon the underwriter to disprove that this is a claimable casualty or accident. Whereas on the American HAL and the London terms, it's a named perils policy, and the burden of proof is on the ship owner to specify that the claim is launched under such and such clause.
We had this discussion in the past, you and I, and you know that we still have very strong views on that, so we'll leave it on the renewal. Anybody would like to ask any questions? Anybody from Captain Sados? Coffee time. Thank you very much. Thank you very much.
Thank you. Let's go for coffee.